Interest rates are rising and stocks are falling, but consumers are still spending. Layoffs are in the headlines, but payrolls keep climbing. After a year of contradictions, what can we expect in 2023? Joining me now, PGIM President and CEO David Hunt. David, thanks so much for coming to the studio.
Jack, great to be with you.
Real quick, PGIM is Prudential's asset management arm. You oversee about $1.2 trillion. I want to ask you about these cross currents. In addition to the one I just mentioned, Atlanta GDP now is a pretty good model. It says 3.4% GDP growth is what it expects. Meanwhile, Chairman Powell is essentially trying to cause a recession, if at least a slowdown.
No, you're really right. It's a very difficult time to call a lot of this. And of course, at PGIM, as one of the world's largest active managers, we only generate excess returns for our clients when we have a view that is not already priced into the market. And right now, so the starting point has to be what's priced in.
Sure.
What's priced into the market right now is that rates will continue to go up a little bit from where they are now. They will stay up for most of next year, but then they will actually begin to drift down as unemployment rises, and we will have either kind of a softish landing or we'll have a mild recession. So that's what you're betting on if you bet the market right now. So we don't actually believe that's the world that's going to hold. When we look out at the level of inflation out there right now, we would say that this is a monetary inflation phenomena that we have not seen in recent memory. The amount of money that was put into consumers in particular pockets over the last 18 months is truly extraordinary. Consumer spending is up 10% year on year. They've got $1.5 trillion in money market funds. They're going to spend for a while more. Wages are continuing to rise.
That's all inflationary.
So all inflationary. So our view is that inflation is going to be very difficult to beat down. So the Fed is going to actually have to keep rates higher and for longer than what's priced in right now. And so we would say that that is likely to cause either a sharper recession at the end of that, or at least a real fight to begin to drop unemployment to probably around 5% to get wages down. So this is going to be, I think, a little bit uglier than people believe right now as you look at the broad numbers.
Okay, so in that environment, what is PGIM saying the best way to actively manage your portfolio is?
So it's interesting. I mean, the great news about higher rates, of course, if you've been owning bonds, you're feeling a lot of pain right now, and rising rates are hard. But higher rates are actually very good for fixed income. So after more than a decade where savers have been brutally penalized by this environment, actually saving money is going to be highly rewarded. So retirees, pensioners, people saving for college are all going to be much more well off. So we actually think that maybe not yet, but sometime in the next couple of months, as we see inflation beginning to come down steadily, this is going to be a very good market for a whole variety of fixed income instruments, probably a lot better than it's been over the last decade.
You manage both institutional money and retail investors. Sometimes they're going in the same direction, sometimes they're splitting. What do you see right now?
No, Jack, it's been one of the most interesting things about the time since March. Retail investors saw inflation coming up, they saw rates going up, they read the statements by the Fed, and they got out of fixed income. And the second thing they did was they got out of growth equity stocks.
Good moves.
They got well ahead of that. So institutions have a very different objective function. Most institutional money is actually being managed to back liabilities, big pension funds, sovereign wealth funds. And so when rates rise, actually their liabilities fall. So most pension funds are actually better funded now than they were at the start of the year by a good deal. And they're using that time to actually take risk off the table. So we've actually seen positive flows into institutional flows, and fixed income has continued to gain assets in there. So you couldn't imagine a more different view. And most institutional investors have not changed their strategic asset allocation. They're sticking with the plan, and they're rebalancing as they need to. But they are not moving kind of the equivalent of money into money market funds the way you see things on the retail side.
Gotcha. Also in fixed income, real quick, in the alternative space, particularly private equity, you see opportunities?
So we have believed for the last few years, and we think this is a trend that will continue, that private assets overall will perform better than many of their public brethren. And I would include in that private equity, I'd include in that real estate, both debt and equity, and private credit, which has been one of the fastest growing areas, and certainly for us. We're one of the largest private credit managers in the world. And after the GFC, banks really pulled back from lending money into the middle market.
Sure.
And so institutional investors and asset managers such as ourselves have stepped into that void to where we're now providing trillions of dollars of money into those lending markets in support of America's companies.
That sounds great. Real quick, in one word, you did not like Bitcoin at 70. I'm guessing 70,000. You don't like it at 16,000 either?
Kryptonite, that's the word.
Thanks very much, David. Appreciate it.
Thanks for having me.